How to build a bond ladder, beginner strategy. What if you could earn steady monthly income without stocks, rental headaches, or crypto risk? It might sound too good to be true, but many wealthy retirees and institutions have quietly used one strategy for decades: bond ladders. A bond ladder isn't about randomly buying bonds and hoping for the best. It's a structured income system. You invest in bonds that mature at staggered intervals. For example, one each year for 5 years. As each bond matures, you get your money back with interest and reinvest it at current rates. That's how bond ladders adapt to rising yields and protect your cash flow, even when markets are chaotic. In 2022, when bond funds lost money, ladders calmly reinvested at higher returns. Today, more investors are realizing that bond ladders offer predictable, low-maintenance income, something most investments can't guarantee. In this video, I'll show you exactly how to build your own bond ladder, step by step, whether your goal is $100 or $1,000 a month. Let's get started. Now that you've seen how a bond ladder works and why it's one of the most stable ways to earn monthly passive income, let's break down what you'll learn in this video, step by step. This isn't a vague overview or complicated financial theory. It's a practical guide you can apply right away, whether you're starting with $1,000 or building a $100,000 portfolio. First, I'll explain exactly what a bond ladder is, in plain English. You'll learn how it generates income, how it compares to other income strategies like dividend stocks or rental property, and why it offers more predictability, flexibility, and safety than most traditional investments. Then we'll dive into the benefits, how bond ladders give you liquidity, regular reinvestment opportunities, and protection from interest rate swings, all without timing the market. After that, I'll walk you through how to build your own ladder, including how many years to span, how much to invest per rung, and which types of bonds to use. You'll see a real example with numbers. I'll also show you the simplified version, using ETF-based bond ladders that require no manual management but still deliver consistent income and principal return. We'll also look at performance, how ladders held up during the 2008 crash, the 2020 COVID shock, and the 2022-2023 rate hikes. Finally, I'll give you an action plan you can follow to start building a ladder that matches your life, even if you're starting small. By the end of this video, you'll not only understand how bond ladders work, you'll know exactly how to build one that supports your personal income goals. This is about designing stability and freedom, one rung at a time. Let's jump in. Let's start with the heart of it all. What exactly is a bond ladder? At its core, a bond ladder is a simple yet powerful strategy that allows you to receive steady income while minimizing interest rate risk and keeping parts of your investment liquid over time. Think of a ladder with evenly spaced rungs. Each rung represents a bond that matures at a different time. For example, you might own a bond that matures in 1 year, one in 2 years, another in 3 years, one in 4 years, and one in 5 years. That's a 5-year bond ladder. What if I told you that you could earn $500 a month in completely passive income without stocks, real estate, or risky crypto? The idea is to space out the maturity dates, so you're not locking all your money in at once. Every year, one of your bonds comes due, returning your full principal. At that point, you have 2 choices. 1. Spend the money. Maybe you're retired and want to use it for living expenses. Reinvest. You buy a new 5-year bond to extend the ladder. This is known as a rolling bond ladder, and it's what gives the strategy its power and adaptability. Why this strategy works, let's break it down further. When you invest in a bond, you're basically lending money to an entity, like the U.S. government, a municipality, or a corporation. In return, they pay you interest, called a coupon, and return your money at maturity. The bond ladder structures these investments so that your money matures and renews gradually, not all at once. This spacing protects you in 2 major ways. The first, from interest rate risk. If rates rise, the new bonds you buy will pay more. If rates fall, your existing long-term bonds are still locked in at higher yields. The second, from reinvestment risk. Unlike a bullet strategy, where all your money matures at the same time, Laddering spreads the risk of reinvesting at a bad rate across multiple years. This makes your income stable and responsive to market conditions without trying to predict the future. Let's say you were planning a 5-year world trip and needed income each year. Would you put all your money into one giant investment that matures at the end of year 5? Or would you space it out so that every year a portion becomes available? Exactly. You'd stagger it. You'd plan it. That's a bond ladder. With bond ladders, you earn money in 2 ways. First, from coupon payments. These are regular interest payments, typically semi-annual or monthly. Second, from principal repayment. When each bond matures, you get your original investment back. Let's say you buy 10,000 bonds in a 5-year ladder. You might receive around $250 every 6 months from each bond, depending on yield, and get $10,000 back each year to reinvest or spend. This structure means you can generate a reliable monthly or quarterly income stream, depending on how you choose your bonds. A bond ladder isn't tied to just one kind of bond. It could be U.S. Treasury bonds, backed by the federal government. Safest option, alternatively, it could be TIPS, Treasury inflation-protected securities, which have built-in inflation protection. Municipal bonds, which are often tax-free at the federal and sometimes state level. Another alternative could be using high-quality corporate bonds. The drawback of using bond funds is, unlike individual bonds, they have no maturity date. This means you don't get your full principal back at a fixed time. The fund's price fluctuates daily with interest rates. You could be forced to sell at a loss if you need cash. With bond ladders, you know exactly how much you'll be paid. When your principal comes back, this gives you control, and that's the single biggest advantage of laddering. So now you know what a bond ladder is. It's simple, it's structured, and when built properly, it becomes your personal paycheck generator, delivering steady, low-risk income without constant management. Up next, I'll show you exactly how to build one from scratch, including what to buy, where to buy it, and how much you'll need. Now that you understand what a bond ladder is and why it works, let's walk through how to build one, whether you're starting with $1,000 or $100,000. Step 1. Define your goal and time frame. Start by asking, what's the purpose of this ladder? Is it retirement income, or a down payment in 3 years, or seeking a stable return in a volatile market? Your objective determines how long the ladder should be. For example, a 3-year ladder is ideal for short-term goals, whereas a 5-year ladder will achieve your medium-term objectives compared to a 10-year ladder, which is more suitable for long-term income planning. The longer ladders tend to offer higher yields, while shorter ladders provide more liquidity. Step 2. Divide your investment. Say you have $25,000 and want a 5-year ladder. Divide it evenly, so at the start, you invest $5,000 each in bonds maturing from years 1 to 5. As each bond matures, reinvest the funds into a new 5-year bond. Over time, your ladder becomes a rolling, income-generating system. Step 3. Select bond types. Pick bonds that fit your risk tolerance and tax situation. U.S. Treasuries, very safe, exempt from state tax. Municipal bonds, often tax-free, great for high-income investors. Corporate bonds, higher yield, modest risk. Stick to investment-grade TIPS. Treasury bonds that adjust with inflation. Choose based on your account type. Use treasuries and IRAs, whereas munis are appropriate in taxable accounts. And corporate bonds are more suitable when tax isn't a concern. Step 4. Where to buy. You can build a ladder manually via brokerage platforms like Vanguard, Fidelity, or Schwab Treasury, Direct.gov for U.S. Treasury bonds. When a bond matures, reinvest it at the furthest end of your ladder. This refreshes your yield and keeps the system rolling. Once a year, reinvest matured bonds, check for credit rating changes, if using corporates, and adjust for any life or financial changes. Coming up next, how to use bond ladder ETFs to automate this process and simplify your strategy even further. If managing individual bonds sounds overwhelming, with staggered maturities, reinvestments, and multiple holdings, there's a simpler option: Bond ladder ETFs. These target maturity bond ETFs offer the same benefits as a traditional bond ladder: predictable income, diversification, and principal return, but with much less manual work. Each ETF has a specific maturity year and automatically returns your capital at that time, just like an individual bond. Instead of buying 5 separate bonds, you can create a 5-year ladder using just 5 ETFs with fixed-term maturities. Each year, one ETF matures and pays out. You simply reinvest in a new maturity, say 2031, and your ladder keeps rolling forward. These ETFs pay monthly income, require low minimum investments, starting around 100, and are available on major investment platforms. Benefits of using ETFs include easy setup and liquidity, buy, sell like a stock, broad diversification across 50 and 500 bonds. No need to track maturities or rebalance manually. However, a word of caution: they can fluctuate in price if sold early, carry small fees, typically 0.05%, and 8%, and principal return is based on market price, not face value, though they generally converge near maturity. ETF ladders are ideal for new investors, busy professionals, IRA, Roth, IRA users, anyone seeking low-maintenance passive income. They also work well in tax-advantaged accounts and are often available as pre-built options from brokers. If you're looking for simplicity with reliable income, ETF ladders are a great place to start. Bond ladders are often overlooked in the passive income space, but they offer powerful advantages over more popular strategies. Unlike traditional bond funds, which lack maturity dates and fluctuate with interest rates, bond ladders return your principal on schedule and let you reinvest at higher yields over time. Compared to dividend stocks, ladders provide guaranteed income without stock market risk or dividend cuts. Real estate can generate monthly cash flow, but it also brings tenant hassles, maintenance costs, and illiquidity, issues bond ladders avoid entirely. Whereas crypto staking may promise high yields, but comes with extreme volatility, platform risks, and regulatory uncertainty. Even barbell or bullet bond strategies rely heavily on timing interest rates correctly, while ladders require no prediction. With staggered maturities, predictable cash flow, and built-in reinvestment, bond ladders offer clarity and consistency in a world of speculation. They're not flashy, but they're smart, stable, and built for long-term income. Okay, so you know what a bond ladder is, but does it actually hold up during market chaos? Let's take a look. During 2008 financial crisis, bond funds dropped 10 to 20% due to panic selling. But bond ladders? Income kept coming, principal was returned. Investors reinvested at higher yields in 2009. During 2020 COVID crash, markets fell 30%. Bond ETFs traded below value. But with a ladder, no selling at a loss. Interest kept coming, reinvested at record low rates. During 2022-2023 rate hike cycle, bond funds saw record losses. AGG fell 13%. But what happened with bond ladders? Rolled forward, reinvested at 4-6% yields, protected income. Why ladders win? Built-in liquidity. Predictable income, no forced selling. Bottom line, ladders don't panic. They perform. Now that you've seen how bond ladders hold up under pressure, let's look at where they really shine in everyday life. 1. Retirement income. Build a 5-year ladder to deliver $40,000 per year. No need to sell stocks during downturns. 2. College planning. Use a 4-year ladder to match tuition needs. One bond maturing each year of college. 3. Business planning. For business owners with known expenses, bond ladders keep capital working and liquid. 4. Institutions and endowments. Ladders help match annual disbursements while the rest stays invested for growth. 5. HNW, income smoothing. Municipal bond ladders offer tax-free income for high earners, trusts, and charitable strategies. 6. Hybrid retirement bridge. Use a 5-year ladder to fund early retirement, allowing equities to grow untouched. Bonus, inflation protection. Add tips to protect purchasing power and balance real return. Bottom line, bond ladders are flexible tools for real financial goals. Simple, strategic, and stress-free. All right, you know what a bond ladder is. Now here's your step-by-step action plan. Step 1. Define your goal. Are you building retirement income, saving for tuition, or matching known expenses? Your goal will guide ladder length and bond type. Step 2. Choose your ladder length. 3-year, short-term goals, low risk, 5-year. Most common, balances yield and liquidity. 10-year ladder. For long-term set and forget income, Step 3. Pick your bonds treasuries. Safe, ideal for IRAs, corporates. Higher yield, more risk tips. Inflation protection, mix to match your needs. Step 4. Divide and invest. Split your investment across maturities. Example, $25,000 over 5 years equals $5,000 per year. Step 5. Reinvest maturities. Each year, reinvest matured bonds into the ladder's longest rung, auto-adjusting for current rates. Bonus, use ETFs. Just buy ETFs that mature each year for 3 to 10 years. You'll still get monthly income, principal returned at maturity, and broad diversification without managing individual bonds. This is perfect for beginners or busy investors. Step 6. Review yearly. You don't need to obsess over your bond ladder, but once a year, reinvest any matured bonds, review yields for new options, check credit ratings, if using corporates. Adjust the ladder if your goals change. This is truly low-maintenance income, but staying engaged helps you optimize over time. Now you know how to build a bond ladder and why it works. If this helped you feel more confident about passive income, hit like, subscribe, and drop your biggest takeaway in the comments. I read them all.